Hello and welcome to Livewire Markets Fund in Focus. My name is Anna Dadich. Today I'm joined by James Rodda of Antipodes to talk about the Antipodes Global SMIDs fund that's been launched as an active ETF under the ticker name MIDS. Welcome, James.
Hi Anna, thanks for having me.
James, can you provide a brief introduction to your firm?
Yeah, look, Antipodes is a global equity investment firm. We founded the business around 10 years ago. I guess the things that differentiate us are a focus on pragmatic value, which means we invest across the growth continuum, but really pragmatic and valuation focused on what we pay. The second thing is, combined with that, let's call it focus on margin of safety for a given level of growth, is deep industry research that we do. So that's a focus on understanding change. And we think that provides, when we get it right, more ways to win on an investment, less ways to lose, and better, risk-adjusted outcomes for investors.
And when did you join Antipodes, and how long have you been investing globally?
I joined Antipodes as a founding member. I started investing in year 4, actually, in primary school. I'd saved up $500. Bought my first shares off the radio advisor, actually, and really got into stocks after that. Started reading books and following the market very closely throughout the rest of primary school, secondary school, and university when I was meant to be studying other things. And then prior to Antipodes, worked at some other firms as well.
You're the PM of the Antipodes Global SMIDs strategy. Talk us through the fund and how does it work and what's different about the way you invest?
Firstly, we invest with that pragmatic value approach, so less style comes through in the fund, I'd say. In terms of process, Antipodes has a large investment team, 30 investment professionals who really focus on industry research. So when I say industry research, I mean change. And what's changing in industries, it might be structural change, cyclical change, political change, that type of thing. What we're looking to do is buy great change stories. And so what you'll find in, I guess, many SMID funds is they have a focus on particular industries or particular styles, that come through in a very concentrated manner. Our portfolio is invested across all gig sectors. And what we're really looking to do is find that change, that underappreciated change in all of the sectors. So it's very diversified. Across sectors, we find great change stories across all of them that are underappreciated, and that's really what we're focused on doing.
So when you say change stories, do you mean companies that might be under distress?
Yeah, I mean, in a cyclical scenario, obviously, if someone's under distress, what you're trying to do is make sure that the cycle does come back, because there's a lot of cycles that don't come back because there is structural change or there's disruption. So think of the internal combustion engine market. It would be uncertain if that's going to have another boom cycle with, say, electric vehicles or hybrids taking market share. Those inflections, when we're at the bottom, what we do is we'll do all the work to make sure the change will happen per normal. In terms of structural change, it's the less obvious change. So, for example, in real estate, we would say data centers are a great opportunity at the moment, but it's very well understood and appreciated. Aged care is something that's really exciting. The demographic boom, the baby boomers sort of the first cohorts hit 80 this year. There's mid to high single digit industry growth. There's been an underbuild, a lack of supply. We need supply and new builds to accelerate to accommodate demand. And we can buy properties in that space, well below replacement cost. And obviously to stimulate that demand, profitability will need to improve. And that's a bit of a COVID hangover in terms of bed utilisation that hasn't caught up yet.
So why should investors consider allocating to global small and mid caps?
Yeah, sure. Look, firstly, I think the opportunity is one of the best opportunities in global markets at the moment. When we look at valuations, for example, traditionally you see a small cap premium, let's call it, in the market. That existed until about 2018. And it existed reasonably consistently throughout history. Since then, we've obviously had large divergence in multiples to the point now where the small and mid caps probably need to appreciate by 50% Obviously, the mean reversion can happen the other way with large and mega caps coming down, but small mid caps would need to appreciate by about 50% to trade at the same multiples. When we look at the growth on a 10-year basis, so 7 years back, 3 years forward, has lagged, but it's only lagged by about 1.5%. And it's, I think the market's extrapolating that difference. So really, it's a fantastic opportunity to participate in, one of the areas of the market that's not trading, any different to long-term multiples at the moment, which I think means you could expect similar returns to what you get over the long run without any multiple re-rate or valuation re-rate. Then in terms of obviously, accessibility, I think it is an area of investor portfolios that is, underweight at the moment. It's obviously difficult to access, and so that's part of the reason we made it an ETF.
Can you highlight one or two of your top holdings in the fund?
Yeah, sure. Look, the first one I'd probably talk about, IWG. Mm-hmm. They sublet office space. Think WeWork.
Mm-hmm. Yeah.
Don't think community adjusted EBITDA. And so what's happened over their long history, as you can see, it's been a pretty disappointing stock. In fact, what they will typically do is lease office space from a landlord, conduct a reasonably expensive fit out, and essentially try to make a spread. Smaller businesses typically. Now, through the lead up period to COVID, we were competing with WeWork, who was obviously selling $1 for 80 cents. WeWork's in new hands now with a new owner. So competition's become a lot more rational. We have around 10 times the scale of WeWork, for context. The second thing that's really interesting is the change in business model. So that business model over a long period of time, we think they put $5 billion into fitting out offices over a very long period of time, made about $5 billion in EBITDA. So not that exciting. Since COVID, there's been a lot of empty office space, and landlords are obviously highly incentivized to have strong utilization of that office space. And so the difference on a 6%, 8% cap rate for a property owner between having a building 30% full versus 60, or even 80 versus 100 is gigantic. So what they've done is they've pivoted the business model to now becoming more like a Hilton or a Marriott. So they will essentially partner with landlords. Landlords spend all the capital for the fit out, which we think essentially lock them in mentally, if not contractually, to operating under this arrangement for a long period of time. And IWG does what it's good at, which is find tenants, run the building, have the office manager, actually design the fit out, procure the fit out, but just not pay for it. And so it's very similar to Hilton or Marriott. They take about 16% in excess of costs. And so the business is transforming from a high capital, low return business to a low capital, high return business with amazing growth. That they've sold thousands of these office spaces now, or they've contracted, that are going to come through in the backlog. And so, if we look at 2028, how does it look? It looks like it's on 6 times earnings, 7 times earnings, still growing 20%. So a really good opportunity to make excellent returns. Probably another one in a different space would be GCC Cement. Mexican listed, 3/4 of the business is actually US cement. We think that onshore construction cycle with US policy is going to improve. Yeah, and the stock is situated really more central and southern US. So firstly in the growth corridors, secondly not subject to import competition. And so regardless of what happens with tariffs, they really don't compete with imported cement like most of the US does. And what that's meant is it's very high return on capital business through time, very high cash flowing business. They've got one of the only new plants in the nation coming on next year online. And when the capex for that plant slows, the stock will be trading at 13, 14% free cash flow yield. which compares to a lot of the larger US names, and I would argue with lower quality portfolios, lower return on equity, lower return on capital, trading on 4 or 5%. So it's not listed in the right jurisdiction. It's smaller, and obviously smaller companies are a bit out of favour. But the quality of the assets are fantastic, and the cash flow that's going to come through once capital expenditures slow down will be fantastic.
Mm-hmm. Okay, and so what are the key risks and how do you manage them?
Yeah, I think, look, the key risk in a small mid-cap fund or even investing in these names is volatility. Yeah. So small mid-caps are more volatile than large caps. And so we're really focused on that. So first of all, we run a 60 stock portfolio, which spreads volatility out and gives you a smoother ride. In terms of behavioural traits, we use that volatility to our advantage. So you will find in small mid-cap names that often they bounce up 20%, down 20% or more with no real good reason. We're very active, and we think it's, small mid-cap investing has been proven to be somewhere that funds can generate good alpha, and they have a great track record of generating alpha. So we're very active in when the expected return on a stock falls because the share price goes up, reducing or exiting that position. And likewise, when it falls for no good reason, we increase our weight. And the last thing I would say in terms of the fund itself, that industry research and the Antipodes philosophy around industry research really reduces risk in small and mid caps. So we follow closely what Amazon is doing, right? And if you're going to invest in a small retailer, I think need to know what Amazon is doing. And the same goes for Microsoft and all the other large caps across all sectors. So by following what the change is at the high level, we're less likely to get run over in smaller names, which can either compete with these companies or be, let's say, downstream winners or losers based on what's going on. So I think that industry research really helps from a risk perspective. It takes a lot of resource. We have a 30-strong investment team. We're not 2 people, 4 people picking stocks like is often the case in small cap and mid cap. And when we look at the outcomes, the down market capture in the fund is under 50% of the benchmark. So the risk outcomes have been excellent in terms of downside capture. And obviously we've had very strong upside capture as well.
Okay, and when's the fund launching?
The fund is launching on the 10th of November. Mm-hmm. We're doing a lot of investor meetings in the lead up, so and post listing. So if you want more information, reach out to Antipodes or Pinnacle, and we can definitely get that to you.
Awesome. Thanks, James, for sitting down with Livewire today, and have fun ringing the bell when it launches.
Will do. Thanks.
If you enjoyed that interview, give it a like, and don't forget to subscribe to our YouTube channel. We release new content every week.